Hi everyone, welcome back to my channel. So many people in India dream of building wealth through the stock market. But here's the harsh truth. Most beginners lose money not because stocks are risky, but because they do not know how to pick the right ones. Some get carried away by hot news, some copy tips from friends, and some buy whatever is trending without understanding what they are investing in. But here's the thing, stock picking, when done the right way, can completely change your financial future. Think about it. If you had invested just 10,000 rupees in Infosys in the early 2000, that amount would be worth lakhs today. The same goes for HDFC Bank or Asian Paint. These are not just stories, they are a proof that the right stocks can help create real wealth. Hey, wait a second. Before we dive into the video, make sure to hit that subscribe button. That way you will get notified whenever I upload valuable finance content. Alright, let's jump into the video. Now I know what you are thinking. With thousands of stocks listed on NSE and BSE, how do you know which one to choose? How do you avoid the hype and focus on what really matters? And most importantly, how do you make sure you are not making the same beginner mistakes that others regret later? That's exactly what this video is about. By the end of this guide, you will not only understand the basics of how stocks works in India, but you will also learn a step-by-step process to pick the right stocks, avoid common traps, and invest with confidence. Before we jump into how to pick the right stocks, let's first clear up the basics. What exactly is a stock? Think of a stock as a tiny piece of ownership in a company. When you buy shares of Infosys or Tata Motors, you are not just pressing a button on your app. You are actually becoming a part owner of that company. If the company grows and make more profit, your share of ownership becomes more valuable. That's why stock prices go up or down. Now here's where most beginners get confused. There is a big difference between investing and trading. Investing means buying good companies and holding them for years, letting your money grow with the business. Trading, on the other hand, is buying and selling quickly to make short term profits. Both exist. If you are a beginner looking to build wealth, investing is the smarter and safer route. And stocks also come in different sizes. You will often hear terms like large cap, mid cap, and small cap. Large cap stocks are the giants, companies like Reliance, Infosys, or HDFC Bank. They are stable and less risky. Mid cap stocks are companies that are growing faster, like Tata LC or Deepak Nitrite. Small cap stocks are the tiny players with high growth potential but also high risk, like newer startups that are just getting listed. Understanding these basics is super important because the type of stock you choose can decide how much risk you are taking and what kind of returns you can expect. Alright, now that we know the basics, the next big question is, how do you actually decide if a stock is worth buying or not? Don't worry, you do not need to be a finance expert, you just need to check a few simple but powerful things. The first thing is company fundamentals. This simply means the health of the company. Look at its revenue, profit, and debt. Is the company consistently making money or it is in loss year after year? For example, HDFC Bank has shown steady profits for decades, which make it reliable. On the other hand, companies like S Bank struggled because of high debt and inconsistent profit. Fundamentals are like the medical report of a company. If the numbers are weak, avoid it. Next, check the industry outlook. Even the best company struggles if the industry itself is going down. For instance, IT company in India grew massively because the entire sector was booming globally. Today, sectors like renewable energy, electric vehicles, digital payments, and pharmaceuticals are seen as high growth areas. But some industries like traditional telecom or outdated manufacturing have struggled to keep up. So always ask yourself, is the sector growing or shrinking? The third factor is management quality. A company is only as good as the people running it. Look at the track record. Infosys is respected not just because of its business, but because of its clean and ethical leadership. Compare that with companies that face constant fraud allegations or sudden resignations at the top. They usually end up destroying shareholder wealth. A good management team thinks about long term value, not just quick profit. Finally, we come to valuation basics. This simply means, are you paying the right price? A popular measure here is the price to earning ratio or P by E ratio. For example, if Infosys has a P by E of around 24 and a newer company like Zomato has a P by E that's sky high, you immediately know which one is riskier. If the P by E is too high compared to competitors, it usually means the stock is overpriced. You can also check book value and dividend yield. These small checks tell you whether a stock is cheap, fairly priced, or just high. And here's a quick reality check. Just because a stock is popular does not mean it's good. Reliance and HDFC Bank become strong investments because their fundamentals were strong, not because they were trending. On the other hand, plenty of penny stocks or hype driven IPOs looked attractive at first but ended up crashing. So before you buy any stock, just remember this 4-step filter: fundamentals, industry, management, and valuation. If a company scores well in these areas, chances are it's a strong pick for the long run. Now, once you know what to check in a stock, the next question is, where do you actually find all this information? Don't worry, it's easier than you think. The first stop is the official websites of NSE and BSE. These sites give you the most authentic and up-to-date company data, including financial reports, results, and announcements. Every investor should know how to quickly check company updates here. Next, we have popular finance portals like Moneycontrol and Screener.in. Moneycontrol is great for beginners because it shows everything in one place: company news, results, balance sheets, and even expert opinions. Screener.in, on the other hand, is amazing for those who want to dive a bit deeper. You can see revenue growth, profit margins, debt levels, and even compare companies side by side. And if you are someone who likes visuals, then learning to read a basic stock chart can help. Don't worry, I am not talking about complicated technical analysis, just look at the overall trend. Is the stock price moving steadily upward over the past few years, or has it been crashing down? A long-term upward trend usually shows that the company is growing steadily. Finally, most brokerage apps today like Zerodha, Grow, and Abstracts come with built-in tools for beginners. You can see live prices, company data, and even simple analysis. The best part is that all of this is available right on your phone, so you do not need to be an expert sitting in front of 10 computer screens. The key here is simple: always rely on trusted sources, not random tips from social media. If your research comes from official data and reliable platforms, your decisions will automatically be more confident. Here's a truth about the stock market that every beginners need to know. Even the best stock in the world carries some risk. The trick is not to avoid risk completely, but to manage it smartly. The first rule is diversification. Never put all your money into just one stock. Imagine you invest everything in one company and it suddenly crashes. You are finished. Instead, spread your money across different sectors and companies. For example, you could hold some IT stocks like Infosys, a banking stock like HDFC Bank, and maybe a consumer company like Hindustan Unilever. This way, if one sector struggles, the other balance it out. The second rule is to avoid penny stocks and tip-based investing. A lot of beginners get excited by stocks trading at 5 rupees or 10 rupees, thinking they can become rich overnight. The reality is, most penny stocks are either manipulated or belong to weak companies with no future. Similarly, never buy a stock just because a friend, a WhatsApp group, or a social media influencer told you to. Always double check the facts yourself. And finally, the most powerful strategy is thinking long term. Many people panic when prices fall and sell at a loss. But if you had held strong companies like Reliance or Infosys during the tough years, you would still be sitting on a massive gains today. Long-term holdings always the power of compounding to work in your favor, while short-term speculation usually benefits brokers more than investors. So to manage risk as a beginner, just follow these three golden rules: diversify, avoid junk stocks, and think long term. If you get this right, half the battle is already won. Okay, now let's put everything together into a simple step-by-step method you can actually follow as a beginner. Step 1. Select a sector. Don't start by randomly picking a company. First decide which sector you believe has strong potential. For example, banking, IT, FMCG, or even renewable energy. A growing sector increases your chances of finding good companies. Step 2. Shortlist a few companies. Within that sector, pick 2 or 3 companies that are well known and trusted. For example, if you choose IT, you could look at Infosys, TCS, and Wipro. Step 3. Check the fundamentals. Look at the company's revenue, profit growth, and debt. Is the company financially healthy? This step will filter out the weak player. Step 4. Compare with competitors. Don't just look at one company in isolation, compare it with its peers. For example, if you are checking Infosys, see how it performs against TCS or Wipro. Sometimes the difference between a great pick and an average pick comes down to comparing numbers side by side. Step 5. Look at valuation. Is the stock reasonably priced compared to its earnings and competitors? If it's way too expensive, it might be better to wait for a correction. Step 6. Make a small investment and track. Don't jump in with a huge amount right away. Start small, maybe with 1 or 2 shares, and then track how the company performs over time. If you feel confident after a few months, you can increase your investment. This simple 6-step process makes stock picking less of a gambling and more of a smart, logical decision. The more you practice it, the more confident you will become. Alright, let's quickly walk through an example so you can see how this actually works. Let's take Infosys, one of the most popular IT companies in India. Step 1. Sector. Infosys belongs to IT sector, which has been one of the India's strongest growth engines for decades. Indian IT companies serve global clients, so the sector has long-term potential. Step 2. Fundamentals. Infosys has consistently shown strong revenue and profit growth, its balance sheet is clean, and the company carries very little debt. That's a sign of financial health. Step 3. Management quality. Infosys is known for its professional and ethical leadership. The company has maintained trust for decades, which is a huge plus for long-term investors. Step 4. Valuation. At the time of recording this, Infosys has a price to earning ratio is the mid-20s. That's not dirt cheap, but compared to peers like TCS, it's in a reasonable range. So if you look at this quick analysis, good fundamentals, strong sector, ethical management, and a fair valuation, it checks most boxes for a beginner friendly stock. Now, does this mean you should blindly buy Infosys today? No. The point of this example is to show you the process. You could do the same for HDFC Bank, Tata Motors, or any other company you are interested in. Once you follow the checklist, you will know whether a stock is strong, risky, or overpriced. Now before we wrap up, let's talk about the mistakes that most beginners make, and trust me, these mistakes are way more common than you think. The first one is chasing hot stocks because of news or hype. You are often see a stock trending on Twitter or in the news because it has doubled in the last few months. Beginners rush in thinking they will make quick money, but by the time they buy, the stock is already overpriced and ready to fall. Remember, if everyone is talking about it, chances are you are already late. The second mistake is investing without research. Many people buy stock just because of a friend or a relative suggested it, or because a random influencer recommended it. This is like gambling, not investing. If you can spend hours researching a phone before buying it, why not spend at least a few minutes researching the company before putting in your hard earned money? The third mistake is ignoring your own risk appetite and goals. Not every investor is the same. For example, if you are a student investing pocket money, you should not take the same level of risk as a 40-year-old professional who is building a retirement portfolio. Know your risk level, know your goals, and then choose stocks that fit your personal plan. If you can avoid these three traps, chasing hype, skipping research, and ignoring your own goals, you will already be ahead of most beginners in the market. So let's quickly recap what we have learned today. Stock picking is not about guessing or following tips, it's about understanding the basics, checking the fundamentals, and following a clear process. We talked about what a stock really means, how to judge companies based on revenue, profit, debt, industry outlook, management quality, and valuation. We also looked at useful tools like NSE, BSE, Moneycontrol, and Screener.in, and most importantly, we covered risk management and the step by step method to actually pick a stock. Thanks for watching and see you again.